just your opinion.
Yeah.
This question kind of ties back with an earlier question, back to the world wars, right? After the first Great War, it seemed like Germany just kind of printed their way out of all that debt. And it seems like it kind of started this ripple effect in macroeconomics of a lot of countries now just almost printing to oblivion whenever they have some sort of economic trouble. US, of course, being a prime example. And all that trillions and trillions of dollars that was already pumped, and now they're pumping again. Well, by the end of this month again, you mentioned the increase in debt needs to be unwound. I thought that was very profound of you to say. Now it seems like on a global scale, everyone is printing. I mean, it's not only the U.S. but Europe, Asia, now even Southeast Asia, smaller countries, Japan. They're already deep in this hole.
Yeah.
Your presentation made it seem like we're going to have another run for another 7-8 years. My question to you is, now that there's so much money in the market and they're planning to inject more, would that not have some sort of economic implication for a downfall sooner than that? Or do you still think it will hold true of the 18 years?
Well, I personally think it's going to hold true for the 18 years. So, I mean, that's actually quite a big question. So I'll be very brief. Look, the sovereign countries can't run out of their own money. So, and, the reality is that when a government spends money, it creates the money first. It doesn't. So, the US Treasury doesn't phone up Inland Revenue and say, oh, I need to spend $1 trillion. Do you have it in your bank account? Can you transfer it over to me? And so I can spend it. It doesn't work like that. The US Treasury spends $1 trillion. It creates that $1 trillion. If it then taxes the economy, it takes that $1 trillion back out again. But the two processes are functionally independent. And so theoretically, governments can print as much money as they want. The actual only limit to how far that goes is when there is idle factors of production in the economy. All of the global economy is well below its productive capacity. So this thing isn't necessarily inflationary. The problem is that, of course, they've gone for things like quantitative easing, and that has essentially just bid up financial assets without necessarily helping the underlying economy. And so I think what we will see from all of this is an enormous bout of land and financial asset inflation that will kind of lead to major boom and then a really major problem in the late 2020s. The final point I'd make about all of that is, so when I was talking about debt needing to be unwound, that's private sector debt. That's a totally different thing. So obviously households have to maintain prudent limits on how much they borrow. And typically at the end of the cycle, people have done far too much of that because the money has been available. Now, I think the effect of, and sometimes the real estate cycle comes back down to stories. What I think we have got now is firstly two things. One is that, by this time next year, we'll look back on coronavirus. We'll have kind of thought, yes, we got through that. And I think that will give us a sense of confidence that our economic masters know what they're doing. And so investors will kind of jump in and they won't feel the return of the global financial crisis. The story will be about Corona, and Corona was, to a certain extent, will be painted as a success story. So that's one story that will take hold. The other story that will take hold is that actually, all this debt, debt to GDP, that level doesn't really matter. And so that will enable a lot of private investors to leverage up to the hilt, which is what you need prior to the peak. And so yes, I think you're right. I still think the timing will be for an 18-year cycle, not before that.